Ladies and gentlemen, good day and welcome to Dynacons Systems and Solutions Q3 FY2026 Meetings Earnings Conference Call hosted by Go India Advisors LLP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Khushbu Singhania from Go India Advisors LLP. Thank you, and over to you, ma'am.
Thank you, Palak. Good afternoon, everyone, and welcome to Dynacons Systems and Solutions Q3 FY26 earnings call to discuss Q3 and 9M FY26 results. We have the senior management of the company on call, Mr. Parag J. Dalal, Executive Director, and Mr. Dharmesh F. Anjaria, Executive Director and CFO. We must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that the company faces. May I now request Mr. Parag Dalal to take us through the company's business outlook and financial highlights, subsequent to which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Khushbu. Good afternoon, everyone, and thank you for joining us today. Welcome to our first ever earning call. We look forward to engaging with you regularly going forward. Dynacons continues to strengthen its position as a leading India-focused IT system integrator and managed services provider, delivering end-to-end solutions across data center and cloud infrastructure, cybersecurity, networking, digital workplace, and managed services. Our integrated platform and deep vendor partnerships enable us to design, deploy, secure, and manage mission-critical IT environments for BFSI, public sector, and enterprise clients across India. During the quarter, the company delivered steady execution across infrastructure transformation, managed services, and enterprise IT modernization. We successfully went live with 38 banks under Core Banking as a Service, an initiative of NABARD for associated state and district cooperative banks, reinforcing our execution strength in mission-critical financial structure programs. We secured several high-value projects across BFSI and public sector, including the enterprise application platform deployment for RBI, a 250 crore order approximately, a digital workplace solution for LIC. We also won key mandates from J&K Bank, State Bank of India, and Bank of Baroda, along with additional orders for advanced core banking solutions from various cooperative banks. We continue to strengthen enterprise digital infrastructure capabilities through execution of SD-WAN and advanced network modernization projects for leading financial institutions. In parallel, we are expanding our device as a service, DaaS, and digital workplace offerings, strengthening annuity-based revenue streams and enhancing long-term client engagements. From an industry recognition standpoint, Dynacons was awarded by Lenovo a 362-scale DaaS Growth Partner of the Year for Asia Pacific, recognized as HPE Solution Provider of the Year 2025 and HPE Partner of the Year, and honored as System Integration Partner of the Year by Versa Networks. We were also featured among India's leading ESG entities 2025 by Dun & Bradstreet, reflecting our commitment to governance and sustainable growth. Demand remains strong across our core offerings, led by data center modernization, cloud adoption, cybersecurity initiatives, and digital workplace transformations. Data center and cloud solutions continue to be our primary growth engine, supported by AI workloads, automation, and data localization requirements, which are accelerating enterprise investment in modern IT infrastructure. Looking ahead, we expect growth to be supported by increasing enterprise investments in AI-ready data centers and cloud, heightened focus on cybersecurity, compliance and resilience, and ongoing digital transformation across BFSI, and public sector enterprises. With strong execution capabilities, a nationwide delivery footprint, and continued investments in AI-ready infrastructure and cybersecurity capabilities, we believe Dynacons is well positioned to benefit from India's accelerating digital transformation and IT spending growth. I would like to now hand over the call to Mr. Dharmesh Anjaria to discuss the financial performance and further proceedings.
Thank you, Parag, and good afternoon, everybody. Dynacons delivered a steady performance in Q3 and 9 months financial year 2026, supported by disciplined execution and an improving solutions mix. For Q3 FY26, revenue from operations stood at 341 crores, reflecting a 10% year-on-year growth. EBITDA grew 49% year-on-year to 41 crores, and EBITDA margins improved to 11.9%. Profit after tax for the quarter stood at 23 crores, up 27% year-on-year. For the 9-month period, revenues reached 1,022 crores, with EBITDA increased to rupees 110 crores and margins improving to 10.7% EBITDA margins. Net profit stood at 66 crores, representing a 21% year-on-year growth. Our margin improvement reflects operating leverage, higher contribution from our solutions and services, and a growing share of value-added offerings. Data center and cloud infrastructure projects, along with recurring managed services and as-a-service engagements, continue to support profitability and improve revenue quality. As on December 31st, 2025, our revenue book stood at approximately 2,389 crores, providing strong revenue visibility. In addition, we maintain a robust order pipeline of approximately 3,083 crores, comprising opportunities across data center and cloud, networking, managed services, and workplace solutions, thus supporting strong conversion visibility and future growth momentum. Demand momentum continues across data center infrastructure, cloud, cybersecurity, managed services, and AI-ready infrastructure, supported by increasing AI workloads, automation requirements, and data localization needs. Overall, our financial performance reflects resilient demand, strong execution, and continued progress towards improving margins and strengthening recurring revenues. With that, we open the floor for questions. Over to you, Khushbu.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
So thank you for the opportunity. Sir, if you could just help us understand what is the margin profile of the cloud and data center, the managed services, and the digital offerings that we provide, so for all these segments.
So, the margin profile for the cloud, data center and cloud, and the network and security, and the managed services is higher than the workplace solutions. However, each segment, we are not disclosing segment-wise, business segment-wise margin profitability, because each segment is supporting the other segments. So for each customer, we are providing multiple levels of services. So, each of these segments supports each other and helps us in building the overall margin profile.
Right. Sir, so I'm trying to understand, so there's a competitor, Unified Data, that has been listed, and they mentioned us as their competitors in their RSP, and they are doing margins upwards of 15-20%. So So can Dynacons reach those levels as the mix of data center, cloud, cyber security increases in our revenue?
So with the product mix that we are there, if you see our product mix, the contribution from data center and cloud has been steadily growing there over the years. It has moved from 14% to 37% as we are today. With that and with the other annuity-based projects that we are getting and the as-a-service business that we are getting, we are looking to improve the profitability as we move along.
Right. So if I look at FY27, sir, what kind of revenue growth can we expect and what kind of EBITDA margins do we expect on a steady state basis?
So, we are not giving any revenue guidance. As per policy, we are not giving revenue guidance there. However, we believe that, our continued focus is to ensure that we improve the product mix and have more revenue and annuity-based engagements and service engagements, which will improve the margin profile there. We believe that you have seen that over a period of time, all the projects that we have taken have been more margin accretive, and hence the overall EBITDA margins have been growing consistently. And we do firmly believe that there is growth momentum and will continue, and continuous efforts are being taken towards that.
Right. So just a final question from mine, and I'll get back in the queue. So out of this 2,400 order book that we have, sir, what would be from data center and cloud and network and security, and what would be the other from IT managed services? And sir, what is the timeline to execute this 2389 crores of order book?
Right. So we've disclosed the overall order book number. However, we currently do not provide a client segment-wise breakup of the order book by BFSI, public sector or global on this call. What we can say is that we are strongly positioned across all these segments and supported by a nationwide footprint and execution track record. In terms of timeline, the order execution timeline ranges from some immediate orders to be executed and some to be executed over a period of 5 years. But an average timeline, if you would put, it would be around 2 years.
Okay. So thank you so much and all the best.
Thank you.
Thank you, sir. Ladies and gentlemen, to ask a question, please press star and 1 now. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Ankur Agarwal from Search Capital. Please go ahead.
Yeah, hi, sir. Thank you for taking that question. So firstly, sir, increasingly we have been seeing that we have been signing a lot of contracts on the new OPEX model versus the traditional EPC work that we used to do. So the first thing that I want to understand is, could you provide a sense of what kind of CAPEX that we are incurring in these deals, and like going ahead in the long term, how is our balance sheet placed to, sort of fund this CAPEX? Because historically our business has been very asset light and we used to throw a lot of cash flows. But now, since we're investing in this CAPEX for the OPEX type of orders, how do you see that thing in terms of balance sheet and cash flows?
Yeah. So what we are doing is we are keeping in mind the prudence and sustainable growth in the as-a-service business there. We are funding these through multiple avenues. One is obviously through some of the internal accruals that we have with us. We are also utilizing, certain lease options there. So we are procuring devices on a long-term lease, which collaborates with the revenue which is being generated from these devices. So we are spreading this mix across both these areas there and raising funds accordingly. Keeping that in mind, as business grows from this, we have a very good support from all the financial institution, banks, and other avenues that we will tap correspondingly.
Right. So I think from a margin perspective, I think this new orders are clearly accretive, but in terms of ROCs, do you believe that you can still maintain the same level of ROCs that we have been doing in the traditional business, or given the kind of sense that you have given that you will be looking to raise debt and all that, which will obviously bloat the balance sheet, you expect that ROCs incrementally will take a hit?
So while we see, with our base also growing there and revenues also growing correspondingly, we do see, this keeping steady for a period of time there. And then we will definitely look at the various alternatives and ensure that the return on capital employed continues to be in a steady state and does not drop significantly. That we are evaluating options accordingly only.
Right. But like to get a sense, like in the long run, how big can this OPEX business be of our overall revenue mix? Now it would be obviously be very small. But in the long run, what number are you sort of thinking that, say 70% of the business will continue to remain on the EPC model and say 20-30% becomes this OPEX model?
So currently, if you see our managed services and the annuity-based revenues around 21% of our overall product mix. We expect this to grow very significantly there over a period of time, because as we see, we've already got orders from BHEL, J&K Bank, the NABARD for core banking as a service. So as these orders start hitting the revenue numbers there, BHEL has started adding to the revenue. The others too will be adding from this quarter onwards there. So you will see a significant up move in the numbers which come across there.
Okay. So in the past, if you see, say, a decade or 15 years, we have been able to improve our margins constantly year after year. Right? In this new OPEX business, obviously the margins are much higher, but can you give a sense of what has led to improved margins in the past? Is it mostly like managed services share increasing, and how do you see that playing out in the future? Like at a PAT level, I'm trying to understand, because obviously at the EBITDA level, because of the OPEX, the margins are obviously higher because the cost of depreciation and amortization is at the lower end. But at a PAT level, do you believe we'll continue to be able to scale margins like what we have done in the past?
So we will definitely, we are seeing a richer solution mix, and we believe that this level is not only sustainable but can be also growing there, especially once we move to a margin enhancement and value-added services. We are still continuing to focus on high-margin solution areas like data center infrastructure, disciplined execution. So all these will definitely contribute to a higher PAT margins there. So we definitely are confident that the PAT margins will also reflect the code, which you can also see that even with a 10% increase in the business there, we have been able to raise PAT margins by 27% in this quarter and 21% overall in the 9-month period.
Right. That was helpful, sir. I have a few more questions. I'll get back in the queue.
Yeah.
Thank you, sir. A reminder to all the participants, to ask a question, please press star and 1 now. The next question is from the line of Neeraj Dalal from 3A Capital Advisors. Please go ahead.
Hi. Congratulations on a good set of numbers. I have 2 questions. The first, sir, is how do you manage the competitive dynamics given that the business is, based on orders from a lot of the PSUs and all of that? That is one. And second, in terms of, the rising costs of hardware and all the IT, products that we will be using, how does that feed into the margin profile that we have and going forward? How is that impacting? Because in the last 6 months, things have not been the same.
Right. Yeah, thank you. I'll take both of these answers. So, we actively manage input costs. This is the answer to your second question. We actively manage input costs and currently do not see material pressures that would impact margins. And this is due to our strong OEM partnerships where we have tied up with them for all these projects there. So we have a vendor buy-in to all these projects there, and we work very closely with them, which helps us mitigate the price volatility there. Plus, we have a lot of productivity initiatives which help us take care of the manpower costs and mitigate them. So overall, we are well placed to mitigate the supply chain issues which are there, which definitely are, you rightly pointed out that. But yes, we are mitigating it through this. Now, coming to the first part of your question, which was around competitive bidding from, for our large BFSI and public sector accounts. So Dynacons has a very, very good track record and good pre-qualifications there to bid at significantly large projects there. Now, these pre-qualifications enable us to bid against companies which are significantly larger than us. So hence the competitive landscape, we are able to get an edge in because we are competing with companies larger than us, and we have a proven track record of projects which have been executed across, whether it is in SD-WAN, private cloud, core banking. These are opportunities, and our service delivery infrastructure give us the lower execution cost because of the experience that we have. These hold us in good stead during the competitive bidding.
Thank you, sir. I'll get back in the queue.
Yeah.
Thank you, sir. Ladies and gentlemen, to ask a question, please press star and 1 now. The next question is from the line of Urmish Shah from Moneyvisors. Please go ahead.
Yeah. Am I audible?
Yes, sir.
Yeah. So, sir, my first question is, I want to know what is the contribution of recurring revenue in our books, and what is the strategy going forward? Are we looking to increase wallet share from our existing clients or adding more new clients?
Right. So, if you've seen our overall managed services revenue is around 21% of our current revenue there, and recurring revenues are forming a large and growing part of our business. We have a substantial base of multi-year contracts and ongoing services there, and many of our managed services deal and devices service deals are multi-year contracts which are providing regular recurring revenue streams. So, which is why we are expecting this business to, successfully continue over a period of time.
Okay. So, but we will be adding new clients as well as we move forward.
Coming to your question there, so Dynacons has, a two-pronged strategy around that. We continue to, harness our existing large pool of enterprise accounts where we are horizontally and doing a lot of cross-selling opportunities there. So while we may enter in through workplace solutions or a managed services opportunity in one of the accounts, but then we are able to cross-sell and upsell there and offer a lot of other solutions to customers there, which gives us a lot of stickiness with the customers there because we are able to work across multiple solution profiles with them. Two, the second strategy is also, around customer acquisition where we keep acquiring large enterprise accounts there which give us the kind of revenue visibility, help us in, building the pipeline for new customers and new solutions to be worked on with these customers.
Okay. So,
and I'll give you an example.
Yeah,
like,
sure.
We entered Punjab National Bank with a small order for services, and then we, went across with the enterprise level security services contract. Then we went with asset management. So, this is how we scale across and upscale.
Right, sir. So, and the second question is, do we look for a minimum revenue visibility when we enter in a contract or secure an order, or if it's range bound, minimum range? Do we look on that front?
While we definitely strive to work on large projects there, but we work on something which is more strategic. So it could be strategic in terms of the product mix and the product line that we are doing up. So, for example, recently for one public sector undertaking, we picked up an order for a AI implementation there, which was a smaller implementation, but a significant start there. Or alternatively, it could be a small order for a large enterprise there. So depending on the products mix there or the customer, being a strategic customer, we decide accordingly and we approach that.
Okay. So, and final question, I don't know if, because I joined the call a bit late, but the margins look very healthy currently. So, what is the sustainable range of margins that you look to maintain going forward?
So, see, our margins have been, the improvement in margins is driven by a solution mix, as we mentioned, and a good operating leverage. And we do believe that this level is sustainable there, because we are clearly focusing on the high margin solution areas like data center, cloud, cybersecurity, and all of these areas. And we are continuing to focus on more as a service opportunities there, especially the core banking as a service, what we have seen there. So it's a mix of not only device but also application as a service there.
Okay. Thank you, sir. I'll join back with you. Thank you.
Thank you, sir. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Bhagya Bansal, an individual investor. Please go ahead.
Yes, sir. Good afternoon, sir. Mr. Bhagya there. Actually, I have a question that although we have grown year-on-year basis on profit and revenue front, but in case of quarter-on-quarter growth, there is a major slump in the progress. It's, I think, I will tell you, it's about, in case of revenue, it's a minus 3.3, and in case of profit, it's a 3.6%. So there is a major slump in the growth we had till now. Could you please inform us about the reason why this has happened?
Yeah, good question. So we would like to, highlight that, we are in a project nature of business there. So our execution, the overall revenue numbers will depend on the execution of the projects there. So it could be completed in one quarter, or it could be spilled over to the next quarter. We are not into the, the run rate sales where we are looking at quarter-on-quarter numbers there and quarter-on-quarter. Yes, definitely we seeing a sustained growth as you have seen across the years, but our numbers will definitely reflect on year-on-year growth there and not quarter-on-quarter.
Okay.
Because a lot of factors which, depends on the execution, site readiness, customers' internal processes, the acceptance there. So, a lot of these factors contribute to this, and which is why you're seeing that while on a year-on-year basis, we are seeing consistent growth.
And so, sir, it can be anticipated that the growth is not expected to come down. It's only the nature of the business which is causing it to appear to slow down?
Yeah. So yes, a quarter on quarter is not a right matrix to measure our growth by. The better matrix is definitely year on year, and you are right. We have already announced several orders during the year there, which are also getting executed as we say there. So all of these factors, we are very confident that the growth momentum that you've seen over the past few years, that growth momentum will continue.
And sir, there's one more question that since we see that there is a certain chunk of revenue which Dynacons gains through, and that's a SaaS, software as a service. And now we can see that Anthropic as a company has released certain tools which are anticipated to cause large harm to anybody who provide SaaS services. So what's the outlook of Dynacons about it, and what do you think that how you are thinking how you will meet this challenge?
So honestly, if you see our revenues are not from providing software as a service. So we are not competing with the likes of Claude and Anthropic, Claude by Anthropic and other tools. In fact, these tools will help us in execution and help us improve our productivity there. So it's a positive impact that we will get, because what we are providing is two types of things. One is we are providing device as a service, and second, we are providing a complete platform and a solution as a service there. So core banking as a service, when I say specifically, involves a lot of things. It involves a DC and a cloud setup. It involves networking and a SD-WAN setup there. It also involves application there. It also involves services there. It involves certain devices, infrastructure as a service. So, which is why we are not, and also cybersecurity. So, which is why we will be using these tools, and these tools will help us improve our productivity in providing these solutions.
Okay, thank you, sir. And I have just some questions, and that's. And you told us, sir, that there is an order book of about 2,500 crores, which is pending. So, how much of it is already completed, or if this complete figure is pending for execution?
So, this is the pending order book as on 31st December.
Okay, and sir, any idea what's the revenue growth anticipated in the next 3 to 5 years?
So, as we mentioned, as a company policy, we do not give any guidance on, the growth there. However, our past track record and the sustained projects that we have there give us good momentum and visibility.
Okay, and sir, and it's anticipated that Dynacons is majorly into government contracts. So, is there any plan to expand further, catering to other segments as well?
Well, actually, I would like to correct that there. If you see, 37% of our revenues, nearly 35% of our revenues come from global customers. So we have a suite of all the large global accounts there, the likes of Facebook, Uber, and Amazon, S&P, Google. All of these are our customers there, S&P, Gartner. So, all of these are our customers there, and they are contributing nearly 35% of revenues to us, number one. Number two, our biggest segment is BFSI there. So, BFSI is also one of our biggest segments there, and, so it's not only public sector that we are working on there. ICICI Bank is one of our largest customers also.
Okay, sir. And
Sorry to interrupt, Bhagya sir. May we request that you come back to follow-up question in question queue?
Okay, sure.
Yes, sir. Thank you, sir. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Madhur Rathi from Counter Cyclical Investments. Please go ahead.
Sir, thank you for the opportunity once again. Sir, I wanted to understand in this scenario where laptop prices are increasing, server prices are increasing, and our order book is 2 years out, that is to be executed over 2 years. Sir, so do we have any price pass-through clause where these raw material or the equipment prices are passed on to the end consumers?
Definitely, while I'll just put in a small note to correct that. So, a lot of the order book that we have is based on some immediate orders to be executed, some to be executed across over a period of 5 years. Now, most of these period orders which are to be executed over a longer period of time with durations exceeding 1 year are essentially more on the services, implementation and as a service contracts which are coming in there. Coming to the orders which we need to execute, yes, definitely, like you rightly mentioned, prices, the entire supply chain globally has been very severely hit due to the entire demand which all these AI factories have created. So definitely the supply chain has resulted in increasing prices. But with all our OEMs, we have a constant support available there, where they are part and parcel of the agreements that we are, the orders that we are winning with the customer, and only along with them, partnering with them, we are able to ensure that there is no hit on us due to these factors.
Right. So, sir, I'm just trying to understand as a layman. So let's consider the example of the RBI Enterprise Application Deployment Order, where I would expect that there would be some requirement of servers and chipsets and all these memory storage servers, all these things, where the prices have increased by maybe 20% over the next 6 months, and we have got this order at 250 crore. So in this scenario, can we go to RBI and ask for increase in the price order book value, or do we need to take the hit and we need to supply them for 250 crores only?
So I would like to clarify here. The order from RBI is for setting up an enterprise application platform. It is only application platform setups there along with implementation and services there. So it is on the entire application software and the services and implementation there. There is no hardware as part of the order.
Right, sir. So, but any order where hardware is required to be supplied by us, in that scenario, how does this go?
So we have back-to-back arrangements already with all the IT vendors there, which are supporting this, and these price contracts. What is agreed with the customer is also agreed with the IT vendor or the OEM.
Oh, okay, so the minute we receive an order, we buy this equipment from Redington or Rashi Peripheral so that our margins don't take a hit.
Correct. We have all these agreements with IT OEMs like Dell, HPE and all there. So these are already tied in with them, so that through them or through the distributors, we can buy it at the agreed pricing. The pricing is already agreed.
Got it. So that answers my question. Sir, so on working capital cycle, sir, how should I look at the working capital cycle for Dynacons as the application and software part of the business increases going forward?
So see, as we are increasing our, the nature of project, the nature of business is mainly project-based, where we are undertaking large-scale projects there, which involve go-live period across, multiple months there. So because of that, obviously, these require a longer implementation cycle. Hence, the debtor days are increasing there. However, we have got very strong support from all the OEMs and the distributors there, which is why if you see the net working capital cycle has actually been, we have been able to improve that over the period of time, because we have got good support in terms of the credit periods there from our suppliers.
Right. Sir, also, if I look at our balance sheet as of September end,
the credibility in execution and track record that we have. Sorry, go ahead.
Right. And sir, what is this ROU asset of 39.4 crores in our balance sheet as of September end?
So, as we mentioned, we are creating, for all these as-a-service projects, we are obtaining assets on lease. So when we obtain assets on lease, we need to create a RTU, right to use asset there, which is what it has been created.
Got it. And so there's a final question from me, sir. What do we see, what do we specify, or what would we call as the USP of Dynacons versus any other player? And sir, we see a lot of capex happening in the data center and cloud side. So what exactly do we provide in this ecosystem? And sir, suppose for a big data center like a Utah or Nextra, are we suppliers to them as well, or how Dynacons sits in this ecosystem? If you could just help us understand.
So when I would say why Dynacons, or what is the USP of Dynacons, we have a very, we have a nationwide presence. We have significant, deep technology, experience and skill sets to, run several mission critical and nationwide IT deployments there. We have done several private cloud rollouts. We have done several nationwide rollouts, multiple core banking and as a service and data center augmentation projects, IT lifecycle management projects. So we have a very proven track record there. We have a nationwide delivery experience. We have strong partnerships with all these majors. And given our experience of 30 years, we have very, very good qualifications. So not only we have good quality qualifications and certifications like CMMI level 5, ISO 20000, ISO 27000, but along with that, we also are possessing all the necessary credentials for bidding in large contracts, and where we are able to compete with companies larger than us.
Right. And sir, where do we sit in this data center and cloud offering? How does Dynacons provide service to these big data centers like Utah or Nextra? Yeah.
So we are, we are a IT services provider and IT solutions provider. So we provide all kinds of IT infra setups for all the data centers there, and we manage these IT infra and which are put at the data center over a period of time. So we really sit in between the traditional data center providers and the customers there. So we have our own, we are not only providing customers as a service provider all these solutions there and helping them through this entire journey on cloud there, but we are also providing these services to data centers, although we provide more to customers there, direct customers. So it is, and whatever we supply to the customers is for their own consumption.
Right. So is it fair to understand that?
Sir.
Right, I'll get back into it.
The question. Yes, sir. Thank you, sir. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference call, please limit your question to 3 per participant. The next question is from the line of Binoy Jariwala from Upachaya Investments. Please go ahead.
Yes, thank you for the opportunity. Am I audible?
Yes.
Yes, sir.
Okay, great. Sir, quick question on the order book. Just wanted to understand the order book a bit in more detail. So is there any seasonality in the order book in terms of any particular quarter where you get a lot of orders from banks, etc., or clients?
So, erstwhile there used to be something where banks and some public sector companies used to have budgets to finish off in a particular quarter of the year there. But now there is nothing like that there. So there is no seasonality or any particular quarter which is heavy.
Understood. And sir, as you said, certain orders which vary from immediate implementation to as long as 5 years, and the average order book is roughly about 2 years. So how do we account for the revenue? Because you'll have a go-live period and then a O&M period. So how do we typically account for revenue in such multi-year contracts?
So all revenues till go-live are accounted immediately because they pass along with the product there, which is as per the requirements of the customer there. Any implementation and services till go-live are billed at the time of the service there. So usually the go-live period varies from 6 months to 12 months there, which is what is the period there. And then post that is the O&M phase, the operations and maintenance phase, which gets billed over a period of time, like it could be a quarterly billing over the next 5 years.
And what would be the O&M component within this 2,400 crore order book?
So it varies from project to project there. So, for example, this order book contains the DAS project for J&K Bank, which is typically billed over a period of 5 years. So it will be billed over a period of 5 years every year, quarter on quarter. And there are some project-based, businesses where typically it is around 60% of the project value is usually billed till go live, and the balance is usually O&M. So 60-40, 70-30 depends on that. Depends on project to project.
Understood. Sir, in the presentation,
sorry to interrupt, Bhinder, sir, your voice is speaking.
Yeah, am I audible now?
Yeah, a little louder, please.
Yes.
Sure. I'm saying between 21 to 25, you've mentioned that your top 10 clients, you've accounted typically for 60% of revenue. So, by the very nature of this business, does it mean that this business is very sticky in nature, and on the flip side, it also means that it's very difficult to onboard new clients?
So here I would like to state that, for us, while the top 10 customers give us around 60% of the revenues as mentioned, however, the top 10, the names in the top 10 keep changing. So it could be one particular BFSI customer who's in our top 10 for, say, 3 out of 5 years there, and then it would be in another year, it could be another one. So we have a set of large enterprise accounts across all these three segments that is there, BFSI, global, and public sector there. So we have a set of large enterprise accounts through whom we while we have stickiness on one hand, we don't have too much of dependency there because we have a larger pool of accounts to work on. And having worked on multiple projects with these customers, that gives us that stickiness also.
Understood. So
sorry to interrupt, Binoy sir.
Do we?
Binoy sir, may we request that you return to the question queue for follow-up?
Sure.
May we request that you... Yes, sir. Thank you, sir. The next question is from the line of Bhavna Jain from Avagrah Capital Advisors LLP. Please go ahead.
Yeah, thank you for the opportunity. Sir, my question is on the order book bifurcation. Like, can you provide the sector-wise bifurcation, at least the major part? Like, how much does it come from the BFSI, and how much is from the government, and how much is from the enterprise?
Well, we are currently not providing a business mix or a customer vertical mix numbers there due to confidentiality and other reasons there with the customers there. That is why we are not providing these numbers. However, what we can state that is that, the revenue numbers that you are seeing, the revenue mix that you see among our customer verticals, there, similar mix you will see among our order book also.
Okay. So for this, fine, no problem. Again, on order book itself, do we have this bifurcation as to how much order book is consists of service contracts and how much is like a one-off IT project or anything like that? Anything like that if you can provide?
So, honestly, all our IT projects have a component of services. They're both embedded and ongoing implementation services. So, that way it is, it is difficult to give you this because we don't have any one-off contracts. All our contracts have a services time.
So how do we see the completion time of this order book, if you can provide that?
So we've already mentioned there, the timeline of the execution of the order book would start from some immediate orders to some which are over a period of time, over a period of 5 years, with an average, because we have some which are like 3 years, 5 years projects also. But on average, we see that the timeline is around 2 years there, so you can then accordingly calculate, if you're looking at some revenue numbers, you can make a calculation from that.
Then in that case, again, on the order book side, what kind of growth should I anticipate at least for the next 2 to 3 years at least?
So as we have mentioned earlier in this call, we are not, as a company policy, we do not give any forward-looking numbers there. However, what we can say is that we are making continuous efforts to ensure that the growth momentum, and we have a fairly good track record, as you can see, over the last 7 years there, and we see this growth momentum continuing. And we have already released all these orders which are there, which also support our statement.
Okay, no worries. We'll look for that another call. Okay, the question again is on the assets.
Sorry to interrupt, ma'am. May we request that you return to...
These questions were... I just have one question again on the asset side, nothing. So, sir, as I can see that from 2025 onwards, we have a bigger fixed asset number because of the data center business or whatever. So, if I want to calculate the ROA on these assets, because earlier we used to be in the services or IT managed sector. So, can I have any number on that as to what is the expected ROA that can I expect going ahead? And are we planning to do more capex again on that lines because of this data center or cloud infrastructure business?
So the recent capex that you've seen is all on account of our as a service business. So we've got a lot of as a service contracts there, which is where you're seeing the capex build up there, and the margin profitability on these is in the same lines there as all these annuity based contracts or services contracts that we see there. So we definitely see a good margin profile on these customers, and as far as return on the capital or return on assets, you will continue to see a similar growth or a stability around those numbers as well.
Okay, we'll look forward to the next call for that. No worries. Thank you so much, sir. Thank you.
Thank you, ma'am. Ladies and gentlemen, in order to ensure that management is able to address questions from all the participants in the conference call, please limit your question to 2 per participant. The next question is from the line of Ankur Agarwal from Search Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity again. So firstly, on I think from FY25, balance sheet has started showing large, lease liabilities, receivable, and payables. The payable part is understandable that you are buying certain devices on lease, but it is the receivable part would be broadly the revenue that is committed, annual revenue that is committed in this OPEX deals, right?
Yes.
Okay. And secondly, sir, in the most of the contracts that we win, are these mostly like L1 tenders? Like on the PSU side, it would be L1 tender, but the global customer and private customers, are those also like L1 type of tenders, or how does it?
No, these are not L1 tenders. In fact, some of these customers, we have multi-year contracts with them also, so it's not L1 bid always. In fact, even in most BFSI bids, we are seeing a lot of QCBS based bids where there is marks given to technical bid as well as the commercial bid. So, it's not always just a L1 bid.
Got it. That was it. Thank you.
Thank you, sir. The next question is from the line of Abhishek Benkar from Genuity Capital. Please go ahead.
Yeah, hello. Thank you for the opportunity. So, what is the pipeline from PSU and government digital transformation initiatives, and how much we are dependent, how much our growth is dependent on government spending cycle? So that is my first question. And another one is, what is the roadmap for geographic expansion? As you mentioned, around 35% are revenues from, I guess, overseas clients. So, do we have any target for further geographic expansion?
So, coming to your first question, we see a very strong and growing pipeline from public sector due to the entire digital transformation programs. And our pan-India presence and execution capabilities is positioning us well to serve these customers. While, government spending can be cyclical, but we usually mitigate this because we have a very diversified customer base as well as a large solution base where we can, work across a lot of solutions with these customers. And also we have a lot of managed services and, devices as a service solutions with these customers, which enable us to work across there over the period of time. And see, the entire digital transformation is just a journey that they have begun. There is a long way to go even for public sector units there. They have a long way to go there, and we are very confident that this will open a good pipeline for us. As far as geographic expansion goes, we have a phased geographic expansion strategy. In the near term, we are focusing on India because the India growth story is not only intact but is very, very strong there. So definitely that's our primary goal. Having said that, we also are we will look at APAC, particularly Southeast Asia, as our next growth there, because we see a strong demand for IT infrastructure and managed services there. And after that, we also see Middle East and Europe there. Currently, we are also addressing these opportunities through our partners because we have a lot of international partnerships with global IT majors there. We also partner with JITA. We are a JITA member, which is a global IT alliance there. So, with these partnerships, we are able to leverage these and execute projects there.
Okay. And I have follow-up question that could you provide any from our order book pipeline, what is percentage of government or PSU business?
So in our order pipeline, we have given business segment breakup there in the presentation there on the various business segments. We've not given customer breakup there. As we mentioned, the customer breakup would be similar to what ultimately, similar to what we are executing currently there, where BFSI will be leading the space.
Okay. And also, are you exploring any inorganic opportunities or acquisition aside from current partnership?
So we continue to evaluate these opportunities as and when they come across there. Currently, the order book and the projects under pipeline are also pretty robust and heavy there, but we are constantly on the lookout there and will act as and when we see an opportunity, right opportunity.
Okay. Yeah, that's from my side. I'll get back in the group. Thank you, sir.
Thank you, sir. A request to all the participants to limit your question to one per participant. The next question is from the line of Bhagya Bansal, an individual investor. Please go ahead. Mr. Bhagya, your line has been unmuted. Please go ahead.
Yes, sir. Am I audible? Hello.
Yes, sir.
So I was saying that just today I saw that your company has a partner with Siegel. So how, what kind of impact you see on your revenues or on the profit growth? I mean, what kind of role this company will play?
So this partnership that we have done is going to help us enhance our cybersecurity solution portfolio and build specific AI-ready cybersecurity services there and offer the same to our customers there. So we definitely see a very strong because today AI is not only playing a role in helping customers, but it is also helping there are growing concerns there because there are a lot of security attacks which are AI driven now. So AI for security and security for AI. Those are really both opportunities. We definitely need AI for security, and definitely we need to secure the AI.
Okay. And it's a follow-up question. Actually, in that statement, it's mentioned that we are planning to go to certain other countries as well. So how this company will help Dynacons to venture out into these countries like Middle East or such countries?
So Dynacons will leverage its own presence, as well as its presence to partners, as we have recently mentioned on the call there, to address the opportunities there. What this company will do is help us in providing the platform for providing AI solutions on cybersecurity.
And is there any plan to venture out into other government contracts in the near future, maybe in a month or 1 year down the line?
So it will go across a variety of contracts. It will not for any one contract or two contracts, but it will go. It will be a holistic addition to the entire cybersecurity portfolio.
Okay. And so just one question. Just one question. Just a question. Sir, what's the Dynacons? What's the difference?
You are breaking up.
I was asking, what's the meaning of Dynacons? This word, how it is derived?
Well, it's derived from being dynamic. So dynamic consulting is the ethos or origin of the word Dynacons.
Okay. Thank you, sir. I hand over to you.
Thank you, sir. Ladies and gentlemen, in the interest of time, that was the last question for today. I would now like to hand the conference over to management for closing comments. Thank you, and over to you, sir.
Thank you, everybody there. It was really nice to have you all at our first earnings call, and we will be, undertaking these regularly there. If there are any further questions or something like that, you can reach out to our IR team, and we will strive to see how these can be taken up. Thank you for all the interest that you have taken in our company. Wish you all a good evening.
Thank you very much, everyone. We really appreciate your time and presence. Thank you.
Thank you, sir. On behalf of Go India Advisors LLP, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.